So, you know those lines everyone draws on stock charts? The 50-day, 200-day moving averages? Yeah, turns out there's an actual reason why billion-dollar hedge funds and your neighbor's trading bot both obsess over the exact same indicator. And no, it's not magic. Look, if you're short on time, or you just refuse to listen to some random guy on the internet talking about charts, here's what today's video's about. Moving averages work because enough people with enough money believe they work. That's it. When the S&P 500 approaches its 200-day moving average, institutions deploy real capital at that level, creating actual buy pressure. It's a self-fulfilling prophecy backed by billions of dollars. So whether you think technical analysis is nonsense or not, ignoring what the big money is watching is just, it's not a great strategy. Alright, so if you're still with me, let's actually break down how this whole thing works, why it works, and yeah, when it completely fails. Right, so first things first, I should probably introduce myself since, this channel is still pretty small. My name is DataCat, and about 7 months ago, I started this whole YouTube thing. Before that, I was a corporate analyst at a Fortune 50 company. Think 4 cups of coffee, meaningless numbers, meetings that could have been one Slack message, the whole 9 yards. Eventually, I just, I traded the corporate grind for lasers and keyboards, and here we are. Now, I'm not going to sit here and brag about being some trading genius or anything, because honestly, that's just not my style, and apparently not the truth. But I actually saw a comment on one of my videos a while back, quite a while back, asking about technical analysis tutorials, and I've been thinking about it for like weeks now. I wasn't sure if it was a good idea because, there's probably better materials out there, right? Smarter people. Bigger channels. But then I figured, you know what? Maybe it's worth showing you how I actually approach this stuff. Starting from the very beginning. No assumptions. So this video is going to be pretty foundational, and we're starting with probably the most common, most intuitive technical indicator out there. Okay, so moving averages. Whether you're an investor or a trader, you must have heard about it or even used it from day-to-day basis. But what are they really? So let's start from the most basic level. A moving average is just math. It's the average closing price of a stock or index over a specific period of time, plotted as a smooth line on your chart. Let's say you're looking at a 50-day simple moving average, right? What that does is it takes the last 50 days of closing prices, adds them all up, and divides by 50. Pretty straightforward. The next day it drops the oldest price, adds the newest one, recalculates. The line just keeps rolling forward. That's why it's called a moving average. And the whole point of this, the reason anyone even bothers with it, is that it smooths out the noise. Stock prices jump around every single day because of news, because of emotions, because someone on social media said something dumb. Moving averages filter out that short-term chaos so you can actually see the underlying trend. Is the stock going up over time, down, sideways? That's what the moving average shows you. Now, one thing you need to understand right away, moving averages are lagging indicators. They do not predict the future. They summarize the recent past. So if you're expecting some crystal ball that tells you what's going to happen tomorrow, this isn't it. What they do is give you a framework for understanding what the trend is right now. And note that the keyword framework is important here. Keep this in your mind before we move on. Alright, so there are 2 main types of moving averages you're going to hear about. Simple moving averages, or SMA, and exponential moving averages, EMA. The simple moving average treats every day equally. So the price from 200 days ago has the same weight as yesterday's price. This makes it slower to react to new information, but it's also more stable. You get fewer false signals. The exponential moving average, on the other hand, gives more weight to recent prices. It reacts faster to what's happening right now. Traders like this for short-term stuff, intraday charts, swing trading, that kind of thing. The downside? In choppy markets, it can whipsaw you around with false signals. Neither one is better. It depends on what you're trying to do, what framework you're in. For long-term trend identification, most people use simple moving averages. For faster short-term trading, exponential is more common. And by the way, cats are kind of like moving averages if you think about it. Most of the time they're just lounging around, ignoring you, lagging behind whatever you want them to do, but then suddenly when they feel like it, they react fast. And you never really know which version you're going to get. Anyway, okay, so this is the part that most tutorials just skip over. They'll tell you what a moving average is, how to calculate it, and then they'll say, okay, now use it. But they don't explain why a line on a chart should have any impact on real price action, because it's just math, right? It's just an average of old prices. Why would that matter? And if you're going to follow someone else or develop your own framework of investing, I think understanding this kind of concepts matters, like a lot. Rest assured, the answer is not mystical. It comes down to three things, and the first one, the cleanest one, is simply the consensus effect. Moving averages work because enough people believe they work. In investing, this is often called a self-fulfilling prophecy, and it's incredibly powerful. Think about the 200-day simple moving average. Who watches this thing? Retail traders like you and me. Institutional portfolio managers. Quantitative hedge funds running billions of dollars. Financial media. Algorithmic trading systems. When the S&P 500 approaches its 200-day moving average from above, all of these participants start placing buy orders near that level. They're treating it as support, and when you have that much collective buying pressure, guess what happens? The price actually bounces. Not because the 200-day moving average is magic, but because enough capital gets deployed there to create a real supply and demand imbalance. The Wall Street Journal has even written about this, questioning whether the widespread use of this indicator makes it self-fulfilling. And yeah, it probably does, but that doesn't make it useless. If anything, it makes it more important to pay attention to. And two, let's not forget about the institutional and algorithmic adoption. This isn't just a retail thing. Moving averages are actually baked into institutional frameworks, even if it's just a simple math and concept. Trend-following hedge funds, the big systematic funds, they use moving average crossover systems as core parts of their strategies. We're talking about funds managing billions of dollars. When a golden cross or death cross triggers, which we'll get to in a minute, their algorithms execute massive orders. That moves markets. Portfolio managers at mutual funds and pension funds often use the 200-day moving average as what's called a regime filter. If the index is above the 200-day, they maintain equity exposure. If it drops below, they reduce exposure or hedge. So you've got real capital flows tied to this indicator. There are famous trading systems built entirely around moving averages. Mark Minervini's trend template, used by a two-time US investing champion, requires stocks to be above their 50-day, 150-day, and 200-day moving averages. Stan Weinstein's stage analysis uses the 30-week moving average, which is roughly equivalent to the 150-day, as the primary tool for identifying what stage a stock is in. These frameworks are taught in best-selling books, and guess what? Thousands of traders and fund managers use them. Well, perhaps another self-fulfilling prophecy here. So when you see a stock bounce off its 50-day moving average, you're not just seeing a line on a chart. You're seeing the result of real participants executing real strategies that are all anchored to the same reference points. And three, the cost basis psychology. So there's also this fundamental logic about this line of our charts. The 50-day moving average roughly represents the average cost basis of everyone who bought that stock over the last 2.5 months. The 200-day represents the average cost basis over about 10 months. When price pulls back to one of these levels, a lot of holders are sitting right around break-even. Psychologically, that's where they're least likely to panic sell at a loss and most likely to add to their positions. So you get natural demand zones that aren't arbitrary. They're rooted in actual market positioning. Cats, by the way, have a natural sense of cost basis too. They know exactly how much effort they put into knocking your cup off the table, and they will defend that investment by staring at you with zero remorse. Alright, now you might be wondering, so why do we use the 50-day, 150-day, and 200-day moving averages? Why not like 63 days or 112 days? Is it random? No. These numbers map to meaningful time periods in the financial calendar. First, the 200-day SMA. This is the gold standard. A full trading year is about 252 days, so the 200-day moving average captures roughly 80% of a year's price action. It's the single most watched moving average across all asset classes. When people talk about whether the market is in a bull trend or a bear trend, this is usually what they're referencing. Above the 200-day, bull market. Below, bear market. Then the 150-day SMA. This is the intermediate bridge between the 50 and the 200. It's about 7 months of data. The relationship between the 150-day and the 200-day is really important in those trend templates I mentioned earlier. When the 150-day is above the 200-day and both are rising, that signals that the intermediate trend is reinforcing the long-term trend. That's what Mark Minervini calls stage 2, which is the accumulation and uptrend phase. That's when you want to be long. Next, the 50-day SMA. This represents the short to intermediate term trend, about 2.5 months. It's the fast-moving average in the Golden Cross and Death Cross framework, which we'll get to in a second. For individual stocks, the 50-day often acts as the first line of support during pullbacks in an uptrend. If a stock keeps holding above its 50-day, that's a sign of institutional accumulation and demand. But then, you might now be wondering, Why EMA for shorter time frames? Now when you get into intraday trading, 5-minute charts, 15-minute, 1 hour, that's when people switch to exponential moving averages. Because in those fast-moving environments, a simple moving average is just too slow. By the time it signals a trend change, the move might already be over. The EMA's heavier weighting on recent prices lets it capture momentum shifts faster. Common periods for short-term EMA trading are 8, 13, 21, which are Fibonacci numbers, or 9, 20, 50. And in this case, day traders often use what's called a cascade approach. They watch for EMA crossovers on progressively higher time frames to confirm that a short-term trend is developing into something bigger. Okay, so now we get to the two most famous moving average signals I often talk about, the golden cross and the death cross. A golden cross happens when the 50-day moving average crosses above the 200-day moving average. This is interpreted as a bullish signal. Short-term momentum has turned positive enough to overtake the long-term trend, suggesting the start of a sustained uptrend. A death cross is the opposite. The 50-day crosses below the 200-day bearish signal. Short-term momentum has deteriorated below the long-term trend, suggesting a sustained downtrend or bear market. And more importantly, these signals get reported in financial media. They trigger automated trading systems. Everyone pays attention to them. But, and this is equally important, their track record is it's nuanced. According to research from Tom Lee's Fundstrat, the S&P 500 was actually higher 1 year after a death cross about 2/3 of the time, averaging a gain of 6.3%. So the death cross has preceded every major bear market in the past century, 1929, 1938, 1974, 2008. But it's also fired during corrections that reversed quickly. We'll also talk about it in a moment. The fundamental limitation is this: because moving averages are lagging indicators, these crossover signals are inherently late. By the time the 50-day crosses below the 200-day, the market has usually already been declining for weeks or even months. That lag is the trade-off of all moving average systems. Alright, so let's look at a real example where moving averages performed exactly as advertised, the famous 2008 financial crisis. In late 2007, the 50-day moving average crossed below the 200-day moving average on SPY, the S&P 500 ETF. This was where the death cross acted like a prophecy, right before hell unleashed. The subprime mortgage crisis was starting to unfold, but most people didn't understand how bad it was going to get yet. Throughout 2008, SPY just bled lower. The 50-day stayed below the 200-day for almost 2 years. Both moving averages were declining, which is what's called a stage 4 decline configuration. Every single rally attempt got rejected at or near the declining 50-day moving average. The 200-day, which had been support during the bull market, became overhead resistance. SPY bottomed near $67 in March 2009. It had come down from highs above 150. And here's the thing, the moving averages didn't call the bottom. They're not designed to, they're trend-following tools, not bottom-picking tools. But as the market recovered through the spring and summer of 2009, the 50-day eventually crossed back above the 200-day. Golden cross. That confirmed the trend had shifted from bearish to bullish. Traders who bought on that signal captured the start of what became an 11-year bull market. So, why did it work so well here? Because the 2008 crisis was a slow-developing, fundamentally driven bear market. It unfolded over 17 months. That's exactly the type of environment where moving averages excel. Prolonged trending markets with clear directional momentum. The death cross fired early enough to protect capital from the worst of the decline. SPY fell another 45% after the death cross. The golden cross fired in time to capture the bulk of the recovery. This was textbook. 50-day below 1, 50-day below 200-day, all declining, confirmed bear market. Then the reverse. 50 above 150 above 200, all rising, confirmed bull market. Now let's talk about a different scenario, when the speed of the move made moving averages problematic. The COVID crash of 2020. On February 19th, 2020, SPY hit an all-time high near $330. All the moving averages were rising and properly aligned. 50 above 150 above 200, everything trending up. There was zero warning from moving averages that a crash was coming. Then, from February 20th to March 23rd, SPY crashed over 30% in just 23 trading days. It fell to around $218. This was one of the fastest bear market declines in history. The speed was so extreme that the 50-day moving average barely had time to even turn down before the market had already bottomed. And then, here comes the brutal part. The death cross finally formed in late March, early April 2020, but by the time it triggered, the market had already bottomed on March 23rd and was already recovering. The death cross was a sell signal at almost exactly the worst possible time to sell, so that signal completely failed. It didn't protect you from the decline, and it would have had you selling right at the bottom. Now, the golden cross formed a few months later, around July, as the market continued its V-shaped recovery fueled by Fed stimulus and fiscal spending. And this time the signal actually worked. After the golden cross formed, SPY went into a clear, sustained bull trend that lasted well over a year. So if you bought on the golden cross, you captured a massive bull run. The catch? By the time the golden cross triggered, SPY had already recovered most of its losses from the crash, so you missed out on a good chunk of the initial recovery gains. But you still would have made money, and more importantly, you would have been positioned correctly for the trend that followed. So the lesson from COVID isn't that moving averages completely failed. It's more nuanced than that. The death cross failed spectacularly because of the speed of the crash. It gave you a sell signal after the worst was already over, but the golden cross still provided value. It confirmed the new bull trend and kept you on the right side of the market for the recovery. You just had to accept that you missed some of the early gains. Why did the death cross fail so badly? Because COVID was an exogenous shock, a black swan event. It wasn't a deteriorating fundamental situation that built over months. The crash was extremely fast, over 30% in 23 days, and the recovery was equally fast. Moving averages need time to react. A 50-day moving average needs roughly 50 days of data to fully reflect a new trend. A 200-day needs even longer. When the entire crash happens in less than a month, the death cross just can't keep up. Kinda like how cats always land on their feet, except in this case, the market landed on its feet, and the death cross indicator was still mid-air, confused about what just happened. But the golden cross? It eventually figured things out, and pointed you in the right direction. Alright, so what do we actually take away from all this? Moving averages work in prolonged trending markets, both bull and bear, where momentum builds gradually over months. They work when trends are driven by fundamentals, like a recession leading to a bear market or a recovery leading to a bull market. They work when you use them as trend filters rather than precise entry and exit signals. For example, only buying stocks that are above their 200-day moving average. And they work best when combined with other analysis, volume, fundamentals, market breadth, sector rotation. On the other hand, they fail during exogenous shocks and V-shaped recoveries, where the speed of the move outpaces the indicator's ability to react. They fail in choppy, range-bound markets where price just oscillates around the moving average, generating repeated false signals. And they fail when you use them in isolation as mechanical buy and sell triggers without considering context, speed, or fundamentals. And in a bigger picture, moving averages are definitely not a crystal ball. What they are is a framework for understanding trend. They help you answer the question, is the market currently trending up, down, or sideways? Their power doesn't come from prediction. It comes from discipline. They force you, to align with the prevailing trend, and they give you objective, rules-based levels for decision-making. The reason they work is a combination of things. Mathematical logic, smoothing out noise to reveal trend. Behavioral finance, the cost-basis psychology, creating natural support and resistance zones. And the consensus effect, widespread adoption, creating self-reinforcing dynamics. But they're lagging by definition. And in fast markets or non-trending markets, that lag becomes a serious liability. The best practitioners, whether discretionary traders or institutional quant funds, never use moving averages alone. They use them as one component in a broader system that includes volume, relative strength, fundamentals, and risk management. And honestly, that's the approach worth adopting if you're serious about this. So, that's moving averages from the ground up. What they are, why they actually work, and when they completely fall apart. I know this was pretty foundational, but I think it's important to understand the mechanics, not just the draw this line and follow these signals part. Because when you understand why something works, you also understand when it won't work. And eventually, you may actually develop a working system on your own. If you found this useful, I'd really appreciate it if you hit the like button and maybe subscribe. I'm still figuring out this whole YouTube thing 7 months in, and honestly, every bit of support helps. No courses to sell here, no premium Discord, just trying to share what I learned from my years in the corporate trenches. And if there's other technical analysis stuff you want me to break down like this, leave a comment. I'll think about it for a few weeks like I did with this one, and maybe we'll do another. Alright, that's it. Thanks for watching. DataCat out, and I'll see you in the next